Hey everyone, Couch Investor back to another video for today. So in today's video, just like the last one, we're not going to talk about a particular stock, but we're going to talk about a segment in the stock market, which is the passive income one. Most of you know, dividends. Dividend paying companies are great, and especially during bear markets. Why? Well, this is what I will cover in this video. Now, dividend paying companies, you can get dividends monthly, quarterly, semi-annually, or annually in rare cases. Now, see what you want to have in your portfolio. In ones that are probably paying you quarterly, or in some cases, real estate investment trust will pay you monthly dividend payouts. Why is that great? Well, it's passive income, so it doesn't really matter if the stock goes down or up. In some cases, it does matter, but over the long term, you will get your dividend payouts regardless, monthly, quarterly, semi-annually, or annually, which is great. You can always reinvest those dividends or keep it in cash. I like to use that dividend to buy more shares. More shares means that over the long term, I get more dividends at the end of the day. Now, before I show you the screener, all the companies that I think might be interesting and explain to you why bear markets actually make a lot of sense to pick up some dividend paying companies, I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Now, Stock Advisor has actually beat the market comfortably over the years. So all you have to do is go to fool.com/couchinvestor or go and check the links down in the description and in the pinned comment to get the best 10 stock picks now. So what happens during a bear market? During a bear market, the stock price of a company goes down, correct? Most of the times, that's a correct statement. During a bull market, the price of the stock goes up. That's also a semi-correct statement. But what happens with the dividend yield? Well, when the price of the stock goes up and the company does not increase their dividend payouts, then usually the dividend yield becomes lower, which is less attractive to investors. But what happens during a bear market? Well, the best thing to a passive income investor happens. Price of the stock goes down, dividend yield goes up, which means for the same amount of money you would have paid 1 year ago, you now get a higher yield. Of course, in some cases, in bear markets, some companies' stock performance goes down, less revenue, less free cash flow, then maybe they will have to cut dividends. That's why you have to look for companies that have a great track record. Regardless of bull or bear market, they kept paying dividends. And this is why bear markets make it very interesting for passive income investors. Because today you can put $1,000 in, let's say, a company like maybe Verizon or AT&T, probably very, very popular, and you'll get a much higher yield than what you would have gotten probably a year ago. The same goes for, well, maybe Apple, Microsoft are not the greatest example, but even they pay a dividend, not that much, but today you'll get more than a year ago. And so now let's have a look at the screener. So I created this screener. Some of you might know the website by now. This is Koyfin. If you want to use it to its fullest potential, there's a link down in the description. You can get 10% off. This is not sponsored in any way. It's just an amazing platform. So I've put here a couple of stocks in various segments and then some metrics. Why? I'll explain in a bit. So you have obviously real estate companies, maybe the most popular one, Simon Property Groups, then Realty Income, they pay a monthly dividend. At the end here, you can see that I've sorted it out by the highest to the lowest dividend yield. The indicated one might grow, might be reduced as well. And so why did I put all these metrics here? So CAGR, total return, in the last 5 years, EV to sales, free cash flow last 12 months, and PE next 12 months. It's to look at companies that might be at risk of not paying a dividend in the future. So it's always great to see a CAGR last 5 years. You can see that most of them are pretty safe, even though those that are in red, it's not really that alarming because as you can see, free cash flow wise, they've got plenty of that. PE, well, obviously dividend paying companies usually have a lower PE than growth companies. But then again, there are some examples such as Simon Property Group, PE of 15.4x. If you look at Coca-Cola, that's also expensive. Then Starbucks, McDonald's, Pepsi, also more expensive. But then again, with them, you look at the CAGR 5 years in the green, EV to sales, quite okay. Dividend yield, just a bit less than $3. And if you go at Simon's, it's 7.3. So quite a nice one there. And of course, REIT real estate, we all know that the real estate market right now is not in a great state, let's say, but that's why it's important to see and look at companies that have strong fundamentals that can continue to pay out those dividends. Of course, some of these companies have already cut their dividends back in 2020 and are now going back on their way up. So you might get less today than you got maybe 2 years ago. But then again, the companies may be a bit more stable today than if they would not have cut dividends. Now, of course, another thing you should be looking out for is a payout ratio. A stock's payout ratio is the amount of money the company pays per share in dividends divided by its earnings per share. In other words, this tells you the percentage of earnings that a stock pays to a shareholder. And if you want an example or a benchmark, so a reasonably low payout ratio, say 60% or less. If it's 70, it's not the end of the world. This is a good sign that the dividend is sustainable. Then, of course, you have the history of raises. So if you have dividend aristocrats, which means that the last 40 years or so, they have been constantly paying out dividends, and usually they have raised that as well. That's another good indicator. Steady revenue and earnings grow. That's why I've put some of these metrics here. Durable competitive advantages. I strongly believe that most of these companies here have that. Maybe not the best of modes, but these aren't new companies. They've been around for a long, long time. Yes, I've put Intel here as well. Sorry, not sorry. And then the last one you should be looking out for is obviously high yield. But then again, high yield is very, very, let's say, subjective, because I'm okay buying a company like Starbucks because it's also a growing type of company. I'm okay buying a company like Microsoft, even though it pays, well, a mere 1.19% in dividends. But as you can see, in the last 5 years, their CAGR is over 25%. It's also a growing company. So I get a return from, well, the growth of the company, which means probably the stock price goes up. And then it also pays me a nice little dividend. By little, I mean a very, very small one. But of course, you can always go to a more stable type of dividend payout. Let's say AbbVie, close to 4% yield, nice return, solid free cash flow. And if you look at EV to sales and PE ratio, not that expensive. So you can always find those companies. That's why it's great to use screeners. You can find great companies that probably nobody has heard of. Obviously, most of these companies here in that list are very, very popular. I'm using this because it's an example so that everybody can understand what I'm trying to explain here. But the main point of this video, again, is to explain to you that during a bear market, a very, very heavy bear market, should I say, it's always great to maybe add a couple of dividend-paying companies in your portfolio. Because let's say we're entering a bull market and suddenly growth stocks are outperforming again. It's always nice to have dividend-paying companies in that portfolio because they're paying you cash just for holding their shares. You can always use that cash to buy more dividend-paying stocks, or you can use that cash for, well, to increase your cash pile or to buy growth companies. It's basically having a small portion of your portfolio that is there to, well, generate cash. So free cash flow, for example. Hence why this is called passive income. Obviously, this channel is focused mostly on growth stocks. In my portfolio, I only have Intel that is paying me a dividend right now, but I am strongly looking at one of these companies that I mentioned today to add to my portfolio, because I do think that today, tomorrow, in the next couple of weeks or months, might be an excellent opportunity to actually add dividend-paying companies to the portfolio that will probably help my growth portfolio in the long term. Obviously, do share your thoughts down in the comments below. Do you own any dividend-paying companies in your portfolio? Let me know down in the comments below, as well as maybe you're looking to add some. Is this helpful? Let me know down in the comments below. If you enjoy this type of videos, give it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. Check out all the other links in the pinned comment. Some of them might actually save you some money. And I'll see you all in the next one. Bye-bye.